Dhirendra Kumar of Value Research joins us. So Dhirendra, good morning. Thank you for joining us. And Dhirendra, at ET Now tomorrow we would be celebrating SIP Day. You know, just like we celebrate birthday, Valentine Day, we would be celebrating SIP Day. And frankly, Dhirendra, it's really the SIP culture which has differentiated Indian markets, of late in last 3 years.
Oh, definitely. It has become mainstream. It was, quite unthinkable a few years back, and we see the results. And a variety of factors driving it. When I come across, and a lot of people are trying to, despite lack of understanding of what it stands for, why they should actually do, it has become some kind of mantra that you have to do SIP. It's a good thing. And this big campaign, the incentive in the B15 cities, the decline in interest rate, that I think is the biggest driver. Everything is working for it, and so the incentive system for B15 that has actually broad-based. So this has really translated into democratization of investment in the right way, because never in the past I have seen a momentum which is of a sustainable kind. Always we have seen big boom in our Indian market led by domestic investors, but that was always seasonal, that was always tactical, that was never of a kind which was like a savings habit coming day in and day out. So I don't think we need to celebrate SIP Day. It should be so mainstream. People earn, people save, and the way to invest should be the way to SIP. And of course, all these events, all this celebration creates awareness that is helpful. But I think we still have a long way to go. 5,000 crore inflow through by way of SIP. Yes, it is glass half full. But looking at the potential, I think we have this country where saving is such a mainstream, deeply embedded individual value. It is very nominal.
Okay, and that's exactly our aim, Dhirendra, as always. So let's start off with some of them who have actually, evinced interest. They do regular SIPs, and I know I'm totally catching you off guard, but while we teased that Dhirendra Kumar is coming on the show, we had some queries coming in, so we thought we'll take them. So one gentleman, that's Kamal Kumar, and he's written in from West Bengal. He says that he's investing into ICICI Blue Chip Fund, ICICI Value Discovery Fund, the ICICI Balance Advantaged Fund, as well as ICICI Long Term Equity Fund. He's saying he's 22 years old, and I'm mighty impressed that a 22-year-old is just so focused and putting in his perhaps first salary into SIPs regularly. He's saying, tell me if these funds are good or bad, and should I be looking at buying other funds as well? So aside of this ICICI stable, he's also got ICICI Banking and Financial Fund and SBI Blue Chip Fund as well. So a fairly diversified portfolio. He wants to know whether he should add more or should he make it more concentrated.
No, one is that I would like to congratulate him that he has got started, but this is not the right way of building a portfolio. I think one should look at it, and I think it's a matter of time that one builds, one evolves, and one learns from mistakes. But one can actually learn faster without doing mistake. And I think a lot of mistakes will not get noticed in a market that we have seen. We are in the 6th year of a positive market for balanced fund and large cap fund and multi cap funds. So investors don't have any, if you have done any mistake, you have done little, you are still in positive territory. But I think the right way of building a portfolio will be choose for multi-cap fund or choose for balanced fund, depending on your experiences, because depending on your tolerance of risk. Somebody who is 22-year-old, I would urge him to build a portfolio of, either for multi-cap fund or a combination of mid-cap and small-cap fund. If he's investing for next 10-15 years, investing regularly, and whenever investing, I would just like to, having a large set of, ICICI Prudential funds, diversifying beyond style and fund managers will be useful, because many fund managers go out of favor and for a while, and that could cause, anxiety. That is unlikely. So diversifying there a little bit and not having too many funds, because at that there is a stage where having too many funds effectively gives you an index kind of return even if you are doing okay. and it can be actually had at a much lower cost with greater predictability.
Coming from S. Hari, Dhirendra, and I think this is a very basic query. Debt funds have given a very strong return in last 3 years because interest rates were declining. That may not be the story for next 3 years. So what should be the average return expectations from a decent debt fund now?
Depends what is the pace of the rate cuts, and the decent return that he's referring to, that has come with lot of hiccups, lot of expectation which did not materialize, and lot of ups and downs, lot of disappointments on the way. So I would say that it will be reasonable to expect a little lower return that you have got in the last 3 years. But I think looking at debt fund, you have to see you have to take a relative view. It is in comparison to what? Compared to what is the question which one should be asking. What you are going to get on a fixed deposit is your benchmark, and what you get on a fixed deposit on which TDS is deducted and all the income from a fixed deposit will be taxable, compared to that a long term or a medium term fixed income fund holding will be tax efficient. It will be subject to capital gains tax. It will be your income derived, which is the underlying nature is interest or fixed income, that actually gets converted into a capital gain, no TDS. So that I think, and superior liquidity, choice, greater diversification. So I think all those things make it very attractive, and definitely it will be able to provide some of the those medium term, long term debt fund categories will be able to deliver, definitely able to deliver more than fixed deposits of the corresponding period.
Dhiren, this one is a peculiar bull market. Like we were chatting yesterday, typically in a bull market, it's the large caps which begin the bull market, or which begin rallying, and then it's the small and the mid caps which catch on. And this time around, one is in that sense seeing a bit of a reverse. It started with small and mid caps, and now is the turn of large caps to outperform. So year to date, maybe large caps are actually holding out a bit better, or rather in the last 3 months or so, they're holding out a bit better. So at a time like this, what is it that you would advise to our viewers who are watching us? Where should they concentrate their bets? Should they pick up large cap equity schemes, or should they look at multi-cap? How is it that they should be, treating and devising their portfolios?
Yes, this market surge has been quite unusual. It started with mid cap. The market did not surge based on the general economy momentum, but primarily on optimism, on the change of government and a lot of things happening, which seems to be materializing. But still the problem remains. So the large cap struggled. They are still, underlying companies are still trying to figure out the way to get out, wriggle themselves out of the trouble. So the market was very selectively, driven by small caps, mid caps, individual companies which were doing very well. Of course, what I find in this whole rally is that some of the small caps, mid cap companies might look very expensive, but still the underlying fundamentals remain. Of course, the price might be completely out of sync with the reality, but nobody can say that those companies are bound to are of a questionable kind. So that despite that, I think this has been the trend. I think we see a reversal of that trend. If you look at 1 year return, we see a very we see a reflection of the trend that has been visible. Small cap giving 4 times more return than large caps. But what I see that now it is I see a reversal of that trend. Recent times, you see the range of the small cap funds in the last 3 months. The best fund and the worst fund, the range is -5 and +5. Of course, I also find that the average return is now in a descending order. The best performing category over the last 3 months is large cap, followed by multi cap, followed by mid cap and small cap. And we see a complete inverse of this these numbers over the last 1 year. I think broad basing of the market is good for sustainability of the market. The fear of height, which I find fear of high, which I find in many investors, might dissipate as market gets broad based on the underlying stock or the preferences. I would say that for most investors getting started, because most Indians still don't invest. if they have to get started, the first choice should be your tax saving fund or the balance fund. And if you have been a little experienced investor, been around, or you are fine with the ups and downs and investing for the long run, it's important to actually remind yourself of invest in the multi-cap funds, and make sure that you are investing for the long term. And a lot of unrealistic expectation has set in. I have come across a lot of queries from readers that they have missed out on the 20% return that they could have derived from the balance fund, and they have gotten used to a healthy yield from the dividend coming their way. That I think needs to be awareness needs to be created about the bankability of those, or too much of trust in the numbers, which is market dependent, which will not materialize all the time, or the consistency of those returns. There will be ups and downs on the way. But last 3-4 years has been outstanding, and the gradual momentum with SIP has only reinforced that.
Let's get closing comments from you, Dhirendra. Last 2-3 years have been great for equity investors, whether you've done a SIP or you've taken the lump sum route. Returns have been double digit across categories. Do you think for next 3 years we should hunker down return expectations to very reasonable estimates? I mean, not more than 7 or 8% for debt, and late double digit in equities? That too also is an optimistic scenario.
If anybody is doing his SIP over the next 3 to 5 years, it is reasonable to expect superior return, or as much return as we have witnessed in the past. The only category about which I am apprehensive is the small caps and the mid caps. Mid caps tending to be small cap oriented. That is the category where I see there could be a reversion to mean. Otherwise, most other broad-based categories, a good part of their portfolio is driven very by a fairly diverse set of underlying portfolio. I am not very apprehensive if one is, and averaging and the market volatility is only helping. In fact, that is very much visible in the balance fund. If you compare the return of the balance fund and the large cap fund over the last 5 years, in all those 5 years, when the market has done reasonably okay, balance funds have delivered superior returns year-on-year basis.
Okay, always,
and I think that is the magic of rebalancing in the underlying portfolio.
Yeah, and need of the hour as well. Really right now that the markets have run up already so much. But great speaking with you, Dhirendra, as always, and thanks so much for taking our viewer queries as well.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.